Hey everyone, welcome back to Corporate Decoder, the place where we dissect the hidden financial stories behind the companies we think we know. Today we're diving deep into a company that's trying to revolutionize the tattoo world with Tech eSmart Corp and their latest annual report. It is a story about big ambitions, small beginnings, and the bumpy road to building a business. So, what exactly is eSmart Corp? Telling us in this document, essentially, it's a company aiming to connect tattoo artists and clients through a digital platform. Think of it as a matchmaking service and a digital portfolio rolled into one, with a dash of AI for good measure. They're hoping to streamline how people find tattoo artists and how artists showcase their work. They even have an AI tool to help generate tattoo ideas. Pretty neat, right? But as always with these filings, the devil is in the details, especially the financial ones. This filing is a Form 10-K, which is basically an annual checkup for public companies. It gives us a detailed look at their performance over the past year, their financial health, and their future plans. eSmart Corp was incorporated in June of 2023, so this is one of their very first comprehensive looks at their financial journey. Now, a quick reality check. The report shows that as of the 31st of August 2025, the market value of their stock held by people not connected to the company, what they call non-affiliates, was $0. This tells us that the company's stock is not publicly traded, or at least not actively traded in a way that generates market value for external investors right now. This is common for very early stage companies. Speaking of stock, eSmart Corp has common stock with a very low par value, just a penny. As of November of 2025, they had about 5.8 million shares outstanding. This is the basic building block of ownership in the company. Let's get a better grip on what eSmart does. They describe themselves as an innovative digital platform looking to revolutionize the tattoo industry. Their core idea is to connect tattoo artists and clients, making it easier to discover artists, view portfolios, and initiate contact. They also offer an AI textual tattoo idea generator, which sounds pretty cool and could be a unique selling point. Their website, esmart.io, is where they aim to house all of this. Their plan to make money boils down to offering their AI tool as an API, meaning other businesses can integrate it into their own products. They're selling subscriptions for this, coming in different lengths like 14-day or 30-day passes. They're also exploring premium features and partnerships, which is a standard approach for growing tech companies. Currently, it is just one significant employee, Ms. Vaselenko, who seems to be wearing all the hats. This is a common situation for very small startups, but it also highlights potential risks related to over-reliance on a single individual for operations and decision-making. Now, for the part that always gets me thinking, risk factors for smaller companies, this section is often waived, and eSmart Corp is indeed a smaller reporting company, so they are not required to list specific individual risks here. This doesn't mean there are no risks, but rather that they are likely covered within the narrative of the business and financial discussions. They mentioned their registered agent's office and their current operational location. For a digital platform, physical property is less of a focus, but it is important to have a registered address for legal purposes. Good news on the legal front, they are not involved in any lawsuits, and they don't know of any pending legal actions. This is always a positive sign, as legal battles can be incredibly draining on resources and focus for a young company. Under this section, they state clearly that the company's stock is not trading at the moment. This reinforces what we saw earlier about the market value being zero. For investors looking for a public market to buy and sell shares, this isn't the place. And don't expect any dividends anytime soon. The company has never paid them and doesn't plan to in the foreseeable future. Their focus is on reinvesting any profits, if and when they arrive, back into the business to fuel growth. They also didn't buy back any of their own stock in the past 2 years, which is perfectly normal for a company at this stage. There is no excess cash to be doing that. This is where the management team explains what happened financially and why. They're upfront about being a development stage corporation with limited operations and minimal revenue. This is crucial context. Let's look at the numbers for the fiscal years ending the 31st of August 2025 and 2024. In 2025, they generated about $29,200 in revenue, which is a jump from around $11,500 in 2024. That's growth, but from a very small base. Unfortunately, revenue growth didn't prevent a net loss. In 2025, their net loss was about $68,000, up from about $41,000 in 2024. This means the company is spending more than it is earning, which is typical for a startup, but the increasing loss warrants attention. Their operating expenses also increased from about $46,000 in 2024 to $87,000 in 2025. These expenses are mainly for things like server rentals and professional services. Basically, the cost of running the platform and getting expert advice. This is about how much cash they have on hand and their ability to meet short-term obligations. As of the 31st of August 2025, their total assets were around $141,000. This breaks down into some cash prepaid expenses and intangible assets. Compare that to around $149,000 in total assets in 2024. Looking at cash flow from operations, they used about $43,000 in 2025, an increase from about $11,000 in 2024. This shows that their day-to-day business activities are consuming cash. Again, typical for a startup, but something to monitor. In investing activities, there was no cash flow in 2025. However, in 2024, they had a significant inflow of about $157,000. This might indicate a prior investment in something substantial, like developing their core technology or platform. Financing activities tell us how they raised money. In 2025, they brought in about $50,000, mainly from a director's loan and selling capital stock. In 2024, they raised a larger amount, about $168,000, again primarily through a director's loan. This signals that the company is relying on its leadership and possibly private investment to keep the lights on. They confirm they have no off-balance sheet arrangements. This is good. It means all their financial commitments and obligations are transparently reported. When preparing financial statements, companies have to make educated guesses or estimates about certain things. This section explains that management makes these estimates and actual results could be different. It's a standard disclaimer. Here is an interesting detail. Prepaid expenses were about $20,000 in 2025 compared to zero in 2024. This represents money paid in advance for services, specifically for a 12-month server lease and SEO services. This means they've committed to these services for the upcoming year. This part talks about how they account for the value of their assets decreasing over time, like software or equipment. They use a straight line method, meaning the value decreases evenly over its estimated useful life. Now we are scrolling to the auditor's report. This is the independent verification that the financial statements are presented fairly. The auditor, Victor Merkwolu CPA PLC, states that in their opinion the financial statements are fair. That's a good sign. However, they also highlight a major concern, substantial doubt about the company's ability to continue as a going concern. This is a serious red flag. The auditor is saying that based on the company's losses, accumulated deficit, and negative working capital, there is a real question about whether eSmart Corp can survive in the long run without more funding. The financial statements don't include any adjustments for this uncertainty, which is standard practice when there is doubt about going concern. This brings us to the balance sheet, a snapshot of what the company owns and owes at a specific point in time. As of the 31st of August 2025, total assets were around $141,000, down slightly from $149,000 in 2024. Their current assets, which are assets expected to be converted to cash within a year, are reported at just under $27,000 in 2025, a significant increase from about $546 in 2024. This is mainly due to the prepaid expenses we discussed. Total liabilities, meaning what the company owes, are around $200,000 in 2025, up from about $180,000 in 2024. A big chunk of those liabilities, about $200,000, comes from related party loans, specifically from the CEO. This confirms they are heavily financed by their leadership. And then there is the stockholders' deficit. Instead of equity, they have a deficit of almost $60,000 in 2025, worsening from about $30,000 in 2024. This means the liabilities are greater than the assets. Moving on to the statements of operations, which show their revenues and expenses over a period. We see revenues of about $29,000 for 2025 and $11,000 for 2024. So revenue is growing. Their gross profit, which is revenue minus the direct costs of producing what they sell, is around $29,000 in 2025, up from about $11,500 in 2024. This shows that the core revenue generation is improving relative to direct costs. However, operating expenses, the costs of running the business beyond direct production, are significant. In 2025, they were about $87,000, and in 2024, they were around $46,000. This, of course, leads to a loss from operations. In 2025, it was about $58,000, and in 2024, it was about $34,000. The operating loss has widened. And with other expenses like interest, the net loss for 2025 comes in at about $68,000, widening from a loss of about $41,000 in 2024. The number of shares outstanding has increased significantly from 4.5 million in 2024 to over 5.5 million in 2025. This indicates that they have been issuing more stock, likely to raise capital. This statement shows how the equity section of the balance sheet has changed. We can see the accumulated deficit growing, reflecting the ongoing losses. As of the 31st of August 2024, they had a total stockholders deficit of about $30,000. By the 31st of August 2025, this deficit grew to almost $60,000. The line item common shares issued for cash shows they sold new shares, bringing in more capital, but it is not enough to offset the growing losses. Now for the cash flow statement, this tracks the actual movement of cash in and out of the business. As mentioned, operating activities used about $43,000 in cash in 2025 and about $11,000 in 2024. This is a key measure of how much cash the core business operations are consuming. Investing activities show a much larger outflow in 2024 of about $157,000, which was not present in 2025. This likely relates to acquiring intangible assets. Financing activities show about $50,000 coming in during 2025 and $168,000 in 2024. This cash comes from loans and stock issuances, confirming their reliance on external funding. The net change in cash. In 2025, cash increased by about $6,300, and in 2024, it increased by about $321. And the cash balance at the end of each period, for 2025, it is about $6,800, and for 2024, it was about $546. It's a small but positive increase in cash, but still a very modest amount to run a business. Let's dive into the notes to the financial statements for more context. This note reiterates their core business of connecting tattoo artists and clients via a digital platform and showcasing artist work. This is a critical note. It echoes the auditor's concern about the company's ability to continue operating. They mention the losses, accumulated deficit, and the need for additional investment capital. They plan to get this funding through director loans and a private offering of common stock. It's a direct admission that without more money, their future is uncertain. This section details the accounting methods used. For example, their revenue recognition follows standard ASC 606 guidelines, recognizing revenue as services are provided, typically over the subscription period. Here we see that their intangible assets, mainly website development and API software, cost about $173,800. They're amortizing this over 5 years. The amortization expense for 2025 was about $34,700. This is the cost of their digital infrastructure. This details their stock. They have 75 million shares authorized. A significant chunk, 4.5 million shares, were issued to Diana Vasilenko at the company's inception. In 2025, they issued another 1.3 million shares for cash, raising about $29,000. This shows a clear effort to bring in outside money by selling stock. This note confirms the substantial loan from the CEO to the company, totaling nearly $201,000 by August 2025. It also details that imputed interest on these loans, which is essentially an accounting charge for the interest that would normally apply, is being treated as additional paid in capital. This means instead of paying cash interest, the financing is boosting their equity value on paper. They state there are no current legal matters that would significantly impact the company. This is good. And finally, they've reviewed events after the 31st of August 2025 and found no material subsequent events to report. This means no major news or changes happened immediately after their fiscal year ended that would alter the financial picture presented. So, what is the story here? eSmart Corp is an ambitious startup in a niche market. They've successfully launched a platform and an AI tool, and they are generating revenue, albeit small. The growth in revenue and gross profit is encouraging. However, the company is clearly burning through cash and is heavily reliant on its CEO for financing. The widening net loss and the auditor's significant doubt about their ability to continue as a going concern are major red flags. They have a plan to raise more capital, but the success of that plan is far from guaranteed. The increased operating expenses and the substantial debt from a related party suggest a continuous need for funding. The company's direction seems to be focused on developing its technology and user base, but the financial foundation is precarious. The key question is whether they can bridge the gap from being a development stage company to a self-sustaining one before their funding runs out. Alright, that is our breakdown of eSmart Corp. Latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives into corporate filings. Don't forget to check out our Discord community for more in-depth discussions. The link is in the description. Thanks for watching. See you next time.